So when does the Wall Street bet gang start to focus in on GameStop?
So GameStop was like a situation that really was created by hedge funds primarily with a lot of hubris. So it was very dangerous. Probably the worst year in history for selling stock short was 2020. Because of all the stuff I just described. The dumbest stuff did the best. So the sort of things that you might naturally bet against, like, hey, this garbage truck doesn't work. They had a video of it rolling downhill. The kid doesn't even, they haven't sold a single one, and it's worth more than the biggest truck maker in the world. I'm going to bet against it. Oops, I just lost a ton of money betting against this thing because people rushed into it anyway. So the things that people felt safe betting against were companies that were total has-beens. And GameStop was going the way of Blockbuster Video. People were not really buying physical media in the video game world very much anymore. They were downloading things, right? It became digitized, or is becoming digitized. Hasn't yet completely. They were betting against AMC theaters that was months away from running out of money, and people were not really going to the movies in the middle of the pandemic. And even if they started to, it was going to run out of money. There was no saving it. So they bet against these surefire losers. But those trades became so crowded that people on Wall Street Bets noticed that, hey, the thing with short interest is when you bet on a stock, the most you can make is infinity and the most you can lose is all your money. When you bet against a stock, that equation is reversed. You have unlimited losses. And so if there's a rapid, for whatever reason, rapid rise in the price of a stock, it doesn't matter why it happened, you might start bleeding a lot of money very quickly and have to buy back the stock. So you don't own it. You sold it without owning it. You borrowed it to repay that loan. Otherwise, your losses will mount, as long as the stock keeps going up, and you might actually run out of money and be bankrupted. And so in the case of GameStop specifically, 140% of the available shares were shorted, which is possible. It's not illegal. It's a lot of misunderstanding about that. It is possible to do, but it's very reckless. And you only would really do it again with the surefire loser. And these hedge funds, they it was a variety of different funds but there's one in particular that had that position on since 2014, a very successful hedge fund on Wall Street called Melvin Capital, that in a period of just a handful of days on that and other stocks lost $7 billion. Since my book came out, it actually went out of business. But it lost $7 billion, needed an infusion of cash. $7 billion is a lot of money. And the amount of money lost collectively by short sellers on GameStop and the other meme stocks goes into the tens of billions of dollars. Short squeezes happen all the time, but they don't happen intentionally. And that's what really got my attention about this story, because I've been following markets for a long time, and it's illegal to do that. It would be illegal if you and I had a hedge fund and we saw someone doing that and we said, hey, let's all gang up on him in secret in some smoke-filled back room and buy a bunch of the stock all at once, and then buy a bunch of call options and stuff like that all at once, then we'll really have him over a barrel and make a ton of money. Well, you can't do that. That's stock manipulation. But what happened in this case probably wasn't illegal at all, because it happened out in the open. It was being discussed. You could go back several weeks and even a few months on Wall Street Bets and see this being discussed and see people telling them the best way to do it. And clearly, there were some savvy people there because they were telling them where they could get the most bang for the buck and how they could ambush these hedge funds.
Okay, so just to clarify, a hedge fund sees a stock that's weak or a business that's weak, right? They say that GameStop is fundamentally flawed like Blockbuster Video. It is part of the past, not of the future. Their fundamentals are terrible. They're going to go out of business. This stock is worth nothing. They make a bet by borrowing massive numbers of shares, which they will have to pay back in the future. Their bet is that that stock price will go way down so that buying them back will be way cheaper than what they borrowed them for in the first place. To borrow them back, there has to be shares available. Sorry, to buy them back, there has to be shares to buy in the future. So the short squeeze, how does the short squeeze work, and what role does Wall Street Bets play in that process?
So if you were to, and this didn't happen, but that's what they thought they were going to do. If you were to have something called a corner, which is an extreme version of a short squeeze, And it used to happen before there was an SEC. This happened on a regular basis. All the Vanderbilt and Gould and all these guys, this kind of Wall Street of yore, they would secretly, because there were no computers, you couldn't see them doing it, they would secretly buy up a whole bunch of stock. To the extent that, like, if you were a short seller, it was not possible for you to buy back the stock that you owed. There's a kind of a classic quote by Daniel Drew, who's one of these old late 19th century speculators, who said, he who sells what isn't his and must buy it back or go to prison. And that's pretty much, true. I mean, like, you're bankrupt. Like, you might have sold this stock at $10, but if I and my group control it all, we could say, well, what's it worth to you? What's all the money? Where's all the money you have? We'll sell it back to you for $1,000. You must return the stock, otherwise, you're out of business. So, that's what they were attempting to do. They didn't quite get there, and that's because this group lacked cohesion. It was like there were some people who thought they were doing that, and they said they would never sell. And even today, who continue to own the stock, they think this short squeeze is going to happen, that it just hasn't happened, and they're phantom shares or all kinds of nonsense. But it came pretty close to happening. And even though it didn't happen, the stock went from, let's say in the spring of, it was less than a $2 stock in the spring of 2020, and it was worth at its peak $483. You've had stocks rise like that before, but you've never had it happened because people had organized online to make it happen. So that's the weird thing that I first noticed. So I said, I've got to write about this. And then it became, an international phenomenon, really, with the meme stocks. And then something else weird happened, which is that Robinhood almost went out of business, almost fried the system circuits and had to halt purchases.
Right, which seems very suspicious if you're part of the crowd that's trying to drive the stock up, and all of a sudden Robinhood halts trading in that one equity, and the guys on the other side of the trade apparently have the chance to at least take a step back, regroup, and so it looks like Robinhood is in the hands of the hedge fund, the dark black hedge fund industry.
Right.
What happens at that point?
Yeah, and just to say, like, hedge funds, this generation is distrustful of Wall Street. This is the Occupy Wall Street generation. Their formative experience were their parents or their parents' friends or whoever suffering during the financial crisis, maybe losing their homes, seeing their savings cut in half, what have you. So they and Wall Street was, seen as the villain there. And so it's not that they had class resentment necessarily. There were rich people like Elon Musk who they thought were great. But people who put on a suit and go to an office on Wall Street, and then especially hedge funds, and then especially short sellers who always have been reviled, it seems like a nefarious thing to do, to bet that a stock will go down. Short selling hedge funds, they were enemy number one. And so hurting them was part of the appeal. It was like really a twofer for most of the people involved. And of course, they aren't a monolith. There are people who were out doing this just to make money, and there are people who are doing this just to hurt hedge funds, but there was a heavy overlap that wanted to do both. And for a while they were doing both until Robinhood pulled the plug.